Welcome back to Talk Tickers. This is the place where we digest the transcripts, the filings, and the absolute mountain of financial noise so you don't have to.
We try to find the signal in there somewhere.
Exactly. And today we are looking at a company that sits at this really strange, almost contradictory intersection of the global economy.
It really is one of the weirdest product mixes on the public market.
I mean, on one hand, they are a total bellwether for heavy industry, making the chemicals that go into everything from PVC pipes to, the glue in wind turbine blades.
And on the other hand, they make bullets. Lots of them.
They're the largest manufacturer of small caliber ammunition in the world.
You just don't often see chlorine gas and bullets on the same balance sheet. But here we are.
We are talking about Olin Corporation. Ticker symbol ONN. And if you've been watching the chemical sector this week, you know it was a sea of red.
Oh, total bloodbath.
But Olin wasn't just, bobbing in the waves. They were practically the lightning rod for the whole sector.
They really were. The story coming out of their Q4 2025 results is, it's intense. It involves what management is calling traff conditions.
Right.
A logistical nightmare on the Gulf Coast and a winter storm named Fern that apparently just did a number on their margins.
It sounds like the plot of a disaster movie, just with more spreadsheets.
It felt like one for the shareholders. Management basically threw up their hands and called it a kitchen sink quarter.
The classic kitchen sink.
They're trying to shrink their way to profitability, but they're fighting a multi-front war right now. You've got subsidized Asian imports, severe weather, and a customer base that just stopped buying in December.
Okay, so before we get into all that drama, and it sounds like there's a lot of it, let's just hit the results snapshot. Because on the surface, the numbers look a little weird.
Yeah, they're contradictory.
Right. So let's start with the pain, because that's what really drove the stock action. The bottom line was a pretty significant miss.
A big miss. GAAP earnings per share came in at a loss of 75 cents.
Okay, and the street was expecting what?
The street was bracing for a loss, sure, but the estimate was around 62 cents, so they missed by 13 cents. In this kind of jittery environment, that is a wide miss.
But here's the part that I think confused a lot of people. The revenue was actually a beat.
Right. The top line looked okay?
They brought in $1.665 billion. That's up nearly 8% sequentially and pretty much flat year over year.
And usually a revenue beat gets you, a polite nod from the market.
Not this time. And this is the critical lesson, I think, for anyone tracking these industrial stocks right now.
The market looked right past that top line and stared directly at the margin collapse. The adjusted EBITDA, which is really your proxy for the health of the business, it just crumbled.
How bad was it?
It came in at $67.7 million.
Just to put that in context for us, a year ago, what was that number?
A year ago, it was $193.4 million.
Wow.
So yeah, it's a face plant. It tells you that while they moved product, they basically made no money doing it. The cost to produce that revenue just ate the profit alive.
And that explains the sell-off. The stock finished the day down, about 6.85%?
Yep, down to $20.81. The narrative from management is, we're at the bottom, this trough environment.
But investors hear that and they just get scared?
Exactly. When investors see EBITDA evaporate like that, the fear isn't just about the trough. The fear is that the trough has a basement and we haven't hit it yet.
So let's unpack this kitchen sink idea. Why was it so expensive for them to do business? It sounds like it wasn't just weak demand. It was like they physically struggled to operate.
It was an operational perfect storm. And I mean that literally. You had three things collide. First, Winter Storm Fern.
Right, that hit the Gulf Coast in January.
Yeah, so technically that's Q1. But the preparation costs all hit in Q4. They had to proactively shut down assets to keep them from freezing.
And for anyone who doesn't follow heavy industry, you can't just flip a switch on a Chlor Alkali plant. Yeah. It's not a toaster.
No, absolutely not. These are massive, continuous process facilities. Shutting them down is incredibly expensive. Restarting them is even more expensive. You lose all your operating leverage instantly.
So that killed efficiency, but it wasn't just the weather.
No. On top of that, they had unplanned outages. They had an extended turnaround at their Freeport, Texas facility.
And Freeport is the crown jewel.
It is the flagship. It's a massive integrated site. So when Freeport sneezes, the whole company catches a cold. And they also had third-party raw material constraints. They couldn't even get the ingredients to run the plants that were working.
So you've got high costs, broken plants, bad weather, and then your customers just vanish.
That was the final blow. They call it the pipeline cliff. In late December, demand for chlorine effectively went to zero.
Zero.
Customers just stopped pulling product. It was an aggressive destocking. Very unusual to see it shut off that sharply.
There was one specific phrase in the transcript that I circled 3 times. Management said they ended the year with caustic soda inventories so low they were at, and I'm quoting here, wet tank bottoms.
That is a vivid image, isn't it? Wet tank bottoms.
It sounds desperate. What does that actually mean?
It's an industry term.
Yeah.
It basically means you are running on fumes. Your tanks are physically empty aside from maybe some sludge at the bottom.
But wait, help me square this. If demand fell off a cliff, shouldn't their tanks be full of unsold product?
And that's the paradox of this quarter. That's why the stock got hit so hard. Demand fell, yes, but because of all the outages and the storm prep, their production fell even faster.
Good.
They couldn't make the stuff fast enough. So the wet tank bottoms comment is crucial because it means they actually missed sales in Q1.
Because they literally didn't have the liquid to put in the truck.
Exactly. It shifts the story from just nobody wants our stuff to we can't make our stuff. It signals a breakdown in reliability, and that scares customers.
Let's break down the business segments then, because Olin is this 3-headed monster, and each head is looking in a different direction. You've got chemicals, epoxy, and ammo.
Let's start with the biggest headache. Chlor Alkali Products and Vinyls, or CAPV.
The core business.
And the core pain point. The segment posted a loss of $14.7 million.
And a year ago.
A year ago, this segment made $75 million. So that's a $90 million swing in the wrong direction.
What's driving that? Is it just the U.S. economy slowing down?
It's bigger than that. It's global.
Yep.
Specifically, it's China. Management was very clear about this. You have subsidized Asian producers just flooding the global market with derivative.
Things like PVC and epoxies.
Exactly. And so think about it from a U.S. manufacturer's perspective. If you can buy finished PVC from China for cheaper than you can make it yourself using Olin's ingredients.
You just buy the finished product from China. Olin gets cut out completely.
Precisely. It destroys U.S. pricing power. Chinese exports of these derivatives are up anywhere from 300 to 600% since 2019. It's a tsunami of deflationary product.
Which leads us right to the epoxy segment. This has been the problem child for a while.
It has. They lost another $19.2 million there this quarter. Now, if you want a silver lining, you have to squint. But that's technically an improvement year over year.
But still, losing nearly $20 million is not a victory lap. And they're shrinking this business, right? They're closing a plant in Brazil.
Yep, the Guaruj plant. They're calling it a strategic retreat. It's a smart move in isolation, saves about $10 million a year in fixed costs.
And their strategy for what's left is interesting. They want to be the last integrated supplier in Europe. What does that actually mean for a customer?
It means they're betting on geopolitical fear. They're telling European customers, look, we might be more expensive than the Asian imports, but we are actually here on the continent. We make the raw material.
They're selling supply chain insurance.
Exactly. They're selling reliability in a market that right now seems to only care about price. It's a bold bet.
Okay, let's pivot to the third head of the monster, Winchester, the ammo business. This always feels like it operates in a different universe.
It was a tale of two markets, a totally split reality. If you look at the commercial side civilian shooters, hunters, that demand has fallen right back to pre-COVID levels. The surge is over.
The pandemic panic buying is done. Everyone's closets are full.
Completely.
Yeah.
The stockpiles are full, but the offset here is the military. Military revenue is up significantly, and that's largely driven by the next-gen squad weapon project.
A big Army contract.
Huge.
Yeah.
They are essentially building a new ammunition plant just for the Army to produce this new 6.8 millimeter cartridge. It provides a steady, government-backed baseline of revenue that has nothing to do with the consumer economy.
There was also a really interesting bit in there about tariffs. We talked about imports killing the chemical side, but it's the opposite with ammo.
This was fascinating. On the chemical side, they're getting battered by imports. On the ammo side, they are sitting behind a fortress. Imports from Brazil, a huge competitor, have effectively hit zero in recent data.
Zero? How is that even possible?
Tariffs. They're as high as 50% on some of these imports. So Winchester effectively has the domestic market protected. It's a massive moat.
So if they have a moat and military demand is strong, why aren't the margins better?
Because the moat is full of expensive water. The costs of copper and brass are just skyrocketing. So even with no foreign competition, their input costs are eating the margin. They're pushing price increases for Q1, but there's always a lag.
The classic inflation trap.
Exactly.
Okay, so when you can't control pricing because of China and you can't control copper costs, you have to control your own house. Olin has this program Beyond 250. It's just cost cutting, right?
It is pure corporate austerity. The target is to cut over $250 million in structural costs. They got about $44 million of that done in 2025, but the heavy lifting is coming now. They're targeting another $100 to $120 million in 2026.
And when we say structural costs, we usually mean people.
Unfortunately, yes. They cut their employee and contractor count by 300 in the second half of last year. They're slimming down aggressively to lower their break-even point.
There was also this messy situation with Dow Chemical, the stranded cost issue. This feels like a detail that gets buried, but it's a lot of money.
It's huge, and it highlights the risk of these integrated sites. Olin and Dow share this massive infrastructure complex in Freeport. Dow decided to close a plant there. When Dow leaves, Olin is left holding the bag for the infrastructure that was meant to serve that plant.
It's like your roommate moves out, but you're still stuck with the full heating bill for a mansion.
That is exactly it. And the bill is $70 million. That's the stranded cost.
$70 million.
They've managed to claw back about $20 million by optimizing power usage, but that still leaves a $50 million hole in their earnings. It's a deadweight loss until they can fill that capacity.
Okay, so looking ahead, investors want to know, is the bleeding over? What's the guidance for Q1 2026?
Well, if you're an optimist, you might want to cover your ears. It is actually going to get worse before it gets better.
Worse than the kitchen sink.
Yes. Guidance for Q1 earnings is expected to be lower than Q4.
Ouch. Why? I thought Q4 was the bottom.
A few reasons. First, turnaround costs. The big Freeport VCM turnaround is happening. That's a huge maintenance event that happens every 3 years. Second, energy costs are up. And here's the kicker. Management admitted they had unhedged exposure to natural gas spikes during the winter storm.
Wait, unhedged? A chemical company in Texas didn't hedge their gas exposure in winter. That seems like a rookie mistake.
Not fully hedged. It seems the severity of the spike caught a portion of their usage unhedged. So they were buying natural gas at the absolute peak frenzy price during the storm. That's going to hit margins directly in Q1.
So if we recap the bear case, earnings are bad, guidance is worse, they have unhedged energy costs, empty tanks, and a storm hangover. What is the stay alive thesis? Why would anyone own this?
Cash flow. That's the only thing holding the floor right now. Despite the gap losses, they generated $321 million in operating cash flow in Q4.
That's surprisingly healthy.
It is. It shows the underlying machine still works. And here's the golden ticket. 2026 is expected to be a cash-free tax year.
A cash-free tax year? How?
You can thank the Inflation Reduction Act. Olin produces hydrogen as a byproduct of making chlorine. They are eligible for significant production tax credits, about $140 million worth. That offsets their tax liability, so they won't pay cash taxes.
So the government is effectively subsidizing their survival through the trough.
In a way, yes. It changes the math on their cash burn. Net debt is flat. They have $1 billion in liquidity. The dividends seem safe. So the thesis is, you own it for the yield, you rely on the cash flow, and you wait for the cycle to turn.
All right, let's pivot. We've covered the gloom, the winter storms, the empty tanks. Now it's time for our This Is Not Financial Advice segment.
The fun part, where we get speculative.
Pitch me the wild trade based on this call. Not the safe investment, but the play on the mechanics we just discussed.
Okay, I've been thinking about this. I'm calling this the Winter Storm short squeeze spread.
I'm listening. Walk me through it.
Okay, so the setup is this. We know Olin was unhedged on natural gas during that January spike. We also know they have wet tank bottoms. Zero inventory.
Right.
The market knows Q1 will be bad, but I don't think they've priced in just how bad the unhedged energy cost will be when combined with the inability to ship product. So leg one, you short Olin aggressively into the Q1 print.
You're betting the surprise is to the downside.
Exactly. Betting the kitchen sink wasn't big enough.
Okay, risky. What's the hedge?
Leg two, you pair this by going long aluminum.
Aluminum. That seems totally random. Why aluminum?
It's not. It's the chemistry. Olin said in the call that global caustic soda demand is being led by aluminum production. Aluminum refining consumes massive amounts of caustic soda.
Ah, okay, I follow.
So if aluminum is booming, it means demand for caustic is tightening. It's a leading indicator. So you short the producer, Olin, while they're a mess, but you go long their biggest customer's industry.
And then how do you close it out?
Then, when Olin eventually restocks in Q2 or Q3, when water treatment season hits and they refill those wet tanks, you flip the trade. You close the short and you go long Olin for the cyclical recovery.
Because the aluminum demand will have forced caustic prices up.
And once Olin's plants are fixed, they'll capture that margin. It's an arbitrage on the weather calendar and the supply chain. You play the operational failure in Q1 and the demand recovery in Q2.
I love it. It's complex, it's risky, and it relies on chemical engineering. Classic stuff.
And completely speculative. Do not do this with your rent money.
Never. And that brings us to the end. The main takeaway here seems to be that Olin is a survivor, but it is currently in the ICU.
It's in the ICU, but it has good insurance in the form of that tax-free cash flow. They'll make it out, but the next 3 months are going to be painful to watch.
Wet tank bottoms. I'm not going to forget that phrase. It really captures the fragility of the industrial supply chain right now.
It does. It shows how close to the edge these giants actually run.
Remember, none of this is financial advice. We are just reading the transcript so you don't have to. Do your own research, check the charts, and watch out for winter storms.
And keep an eye on those natural gas prices.
Thanks for listening to The Deep Dive. Keep watching the tickers.